Now, one of the common things in businesses is businesses generally are valued at a multiple of profit. And I don't want to bore you with crazy accounting terms, but we use a term called EBITDA. It stands for earnings before interest, taxes, depreciation, and something called amortization, which is the write-off of intangible assets in a business. So that's like the uniform measure. You might see, net operating income, you might see SDE. They're slightly different. I won't bore you with why, but EBITDA is the true measure that everyone's going to look at the businesses for. And there's two things that drive a valuation multiple. The first one is the size of the profit, right? So the bigger the profit, the bigger the business, the multiples go higher. That's why a company like Apple, it's worth 24 to 25 times its EBITDA, whereas most small businesses are worth between 2 and 3. In fact, the average last year was about 2.8 times. And then the other thing that drives the valuation multiple is the sophistication of the business. If you've got a low growth, low margin, boring company with not a lot of prospects, that's going to drive the multiple down. Versus if you've got if you've got a SaaS company or a medical device company that's high growth, high margin, lots of IP, lots of barriers to entry, that's going to drive the multiple up. So what we're really targeting is these $1 to $5 million revenue deals. Because don't buy a business that's less than $1 million in revenue, because you're really inheriting a job. The existing business owner is going to be doing a lot of that work in that business. And then when you go above $5 million in revenues, that's where all the buying action is. That's where all trade buyers are and investors. And actually, 95% of all businesses in the world are less than $5 million in revenue. So that $1 to $5 million sweet spot is really where we target. And what's really cool about doing deals is, let's say you buy a business and it's doing $3 million in revenue, so it's in the sweet spot, and it's got a 10% profit margin, so it's cash flowing $300,000 a year. From the multiple slide I showed you, let's say we're going to pay a 2.5 times multiple to buy that business. So we're going to be paying $750,000. We're going to be financing that deal for about $750,000. But then, let's say over 3 years, you grow that business. You grow it from 3 to 5 million. You can increase the margin from 10 to 20%. So now you've got a business that's cash flowing $1 million a year. And then, as you know, the bigger the cash flow, the bigger the multiple, that's going to be worth at least a 5 times multiple. So you can sell that in 3 years for $5 million. Let's say you still owe about $500,000 in financing at that point. You're still going to net about $4.5 million in 3 years just from doing one deal. And that's just the exit. That's just when you sell. You're still going to make about $1.5 million in cash flow as the owner over that 3-year period, and then you might make a little bit at the closing table. So one deal, which would be very easy to do, will make you $6 million over about 3 years. And plotting it onto the chart, $50,000 might be the cash you make at the closing table, $1.5 million cash flow as the owner, but then the big money, the real value, comes from the exit, when you can buy a business, scale it, and then sell it at a multiple. Everybody here know Pace Morby, sub 2? Yeah, so Pace. So I met Pace for the very first time about a year ago. He invited me to speak at his sub 2 mastermind in Phoenix, and I went on his podcast. And he and I are really good friends, we're business partners. And he asked me a really cool question. He said, "Hey, Carl, should you buy real estate or should you buy businesses?" And the answer is you should do both, right? So I said to Pace, "Dude, go buy some businesses." And he said, "Dude, go buy real estate." So now I'm buying real estate and he's buying businesses, and we're coaching each other. It's really, really cool. So, but let me give you some returns, right? So, but repeat after me. I love numbers, and numbers love me. Right, so let me show you these numbers, right? So this is why you should do both. Let's say you're a real estate investor and you want to do fix and flips. So let's say you find a house worth $300,000, and let's say you need $75,000 of equity to get into that deal, and then you might spend $60,000 on improvement costs. So your total cash in on that deal is, say, $135,000, but then you can sell that. The ARV on that is going to be $425,000. You can flip that in 3 to 4 months. You make $65,000, which is great. You invested $135,000. You've made $65,000 profit. That's a 48% ROI. Who wants a 48% ROI? It's pretty decent, right? What's the bank going to pay you on your money? 1% if you're lucky? But if you buy a business, right, the returns are exponentially higher. Ryan interviewed me on his podcast yesterday, And we were talking about this. Like real estate, it's a lot more static, a lot more passive. Like you don't have to do as much to kind of scale it. Businesses are a lot more organic. You've got to get involved, you've got to do some stuff, right? But even though it's going to take you more time as a business investor versus a real estate investor, the returns are a lot higher. So if you took that $75,000, the most you'll ever have to put down to buy a company in equity is about 10%. Most of the cases, it's zero. But even if you had to put that 10% down, that's $75K, that's going to give you about $750,000 of buying power. And I told you before that businesses, on average, worth about a 3 times multiple. So you're buying $250,000 of cash flow in its current form. You get into that business, you spend a few months tweaking some things, adding some growth, cutting some costs. 3 months' time, you might have a run rate of $350 a year in cash flow. You sell that for a 4 times multiple. You just sold that business for $1.4 million. You pay off the debt. You've made $725,000 of profit. You could do that in 90 days. That's almost a 10 times return on your money. So it's a lot higher returns than a real estate deal. Real estate's not going to 10x your money within a year, but it's a bit more of a passive investment. Businesses, they need a little bit more.